Live from London, this is Bloomberg Daybreak Europe. I'm Bonnie Quinn with your top stories. Donald Trump's new 10% global tariffs kick in as the White House seeks to preserve the president's key economic policy. Stocks in Asia shrug off the AI scare trade that dominated Wall Street as investors snap up chip makers. European futures pointing to a higher open. And the European Union fails to agree on a fresh round of sanctions on Russia as the war in Ukraine enters its fifth year. Okay, so stock 600 futures pointed higher. So are futures on the S&P 500. A little bit of relief today after a drop-off yesterday to the tune of 1% for the S&P, 1.2% for the Nasdaq 100. This, of course, after the Citrini report caused another AI scare across various trades, from payments to technology shares in general, and the idea that Anthropic's code can potentially disrupt COBOL. That caused IBM itself to drop the most since October 2000. IBM having to come out and defend itself on a blog saying, look, it's not just a code, it also has value in terms of being a mainframe. You did see, though, a flight to treasuries as well. This, of course, on the tariffs too. We just had those posted to the customs website. 10%, not the 15% that perhaps Donald Trump had mooted at one point. So maybe that's also a little bit of relief in there. But the 2-10 spread now is quite flat. We're at 58 basis points. So let's look at some risk events on the horizon potentially today. Obviously, we said it, the war in Ukraine is entering its fifth year. Difficult to believe, but that's 5 years of war now. 2:30 p.m. UK time, we get the Bank of England's Bailey and various others giving evidence to Parliament, to the Treasury Committee. So will a March rate hike be on the agenda? We'll see if we get any clues. And then 2 a.m., so almost 12 hours later, we have President Trump giving the State of the Union address. And we'll be curious as to whether he stays on script. President Donald Trump's new 10% global tariffs kicked in just more than an hour ago. But an administration official says the White House is working on a formal order increasing the levy to 15%. That's after the Supreme Court struck down Trump's original sweeping duties. Let's bring in Bloomberg's Roz Matheson. Roz, the new tariffs have come into force now. We know it's 10%. But is it fair to say there's maybe confusion, even market uncertainty about trade policy still?
Well, certainly some market uncertainty, certainly a lot of confusion for companies and countries alike, because we've got that flat rate of 10%, but administration officials saying they're looking for ways to push it up to 15%, as Donald Trump threatened at the time. So will it go to 15%, and what kind of landscape does that create globally in terms of winners and losers? So you did see market volatility yesterday, although nothing like what we saw a year ago. And honestly, markets seem to be turning back more to the AI scare trade, if anything now. But watching closely to see how do you pick relative winners and losers from this, because it might not just be that one country is better off in totality than other countries if we start to move more towards sectoral tariffs again. So using these investigations to target certain industries, do you find that certain sectors in certain countries are better off and worse off than others versus countries as a whole? So for markets, trading this is quite complicated because it's changing so quickly. But we do know at 10% at least, some countries on the surface of it seem to be better off than before. Watching, of course, allies like the UK and Australia who'll be hoping that doesn't go back up to 15%, which is more than their trade deals agreed to. And of course, big questions for blocs like the EU, which is wondering, are parts of this deal actually going to be worse off for them? Does it break some of the parameters of what they've already agreed to for certain things like butter, for example? So there's a lot of unknowns in all of this, and so trading it is quite difficult. Picking certain, companies or sectors again is tricky.
Yeah, and I mean, it's punishment being meted out, right? And we say it's on countries, but of course it's always on the companies and on the consumers. Now, these new levies, they can only stay in place for 5 months. So how are we going to get to some certainty and stability in global trade? Do we just give up on having that ever again?
Well, it's certainly a very uncertain landscape, and it's been that way for a while. But as you say, these things roll off after a certain period. And so what we see is the administration already moving towards saying, can we launch investigations under other sections for national security, for example, for anti-discrimination, and target a whole variety of sectors, again, batteries, plastics, you name it, and have those investigations. And therefore, can you then target certain sectors across certain countries? And what kind of landscape does that create? Are they trying to recreate something that approximates what they had before? So that is going to create uncertainty. But oddly enough, the one thing that Donald Trump can't do now is use those emergency levers to change course very abruptly. He has to go back to these investigations in a way, and they've got to run their course. So perhaps a little bit of visibility may come into what might be coming down the pipeline for countries and companies on that front. But it certainly seems that Donald Trump does like to keep investors, markets, businesses and countries on their toes.
Yes, and some of those investigations are already ongoing, Roz, and we're waiting for decisions on them. So it'll be fascinating to see how long these take. That is Bloomberg's chief Asia correspondent, Roz Matheson. US futures then pointing higher as the so-called AI scare trade shows signs of cooling, at least today. A series of warnings about the disruptive power of AI dominated Wall Street's session. They included the Black Swan author Nassim Taleb predicting bankruptcies in the software sector, and also a bearish report by a firm called Citrini Research. Now, the author of that report told Bloomberg even he was surprised by the reaction.
I thought there was going to be a small reaction. It was definitely larger than we expected. But I think it's not that surprising when you take a step back and consider kind of where the markets are in the U.S. The AI trade has been going on for 3.5 years. It's been more or less a straight line up. And essentially, like, everyone is max long today. And so there really aren't many incremental buyers left. And so it, on the one hand, spooks people when you do consider what is negative about this. But I think specifically the market right now is trying to digest this idea that AI has gotten a lot more powerful in the last 6 months.
Let's bring in Bloomberg MLive strategist Mark Cranfield for more now. Mark, the session in Asia shrugging off AI concerns. Of course, we're back from the Lunar New Year holiday, so that has something to do with it. But is the market taking a decision on, AI in terms of, well, Asia has the picks and shovels of AI, for example?
Well, it's very interesting because that interview actually ran live this morning during the Asian session. And the bit that you don't hear in that part of the report there is much more favorable for Asia than it was for the American markets yesterday. So the key point from Asia's point of view is that the companies that are going to continue to do well for the time being are people like the chip makers and the people running the data centers. Now, Asia has those, and it has the big ones. It has Samsung, SK Hynix, Taiwan Semiconductor, and others as well. So that's part of the reason why you've seen tremendous performance continuing with the Korean stocks, Taiwanese stocks, and certain parts of the Chinese market as well today, and some names in Japan, because they're the ones that are in favor from this report. Now, the ones who are really going to be in trouble are people like the intermediaries, the people that do things like insurance and banking. They were the ones that came out not so well from the report and from the interview today. They were particularly hard hit in the United States last night. That may continue today. Although US equity futures are slightly higher, that's really just following on the tails of what's happened in Asia today. There's no certainty that will continue in the American markets later. And of course, they're waiting for NVIDIA as well. NVIDIA has set very high bars in the past and has achieved it, continue to do well. But this week, probably more than ever, the bar is extremely high to satisfy investors that NVIDIA can still make money at the kind of rate that it has been in the past and continue with very attractive forward guidance. A very big week for US tech stocks, and it all comes to a head in a couple of days' time.
Yeah, and we're not really that far off our record for NVIDIA either, so we're pretty high up there. Just changing subject matter a little bit, the dollar is climbing versus the yen about 0.3% after a report by Nikkei that the US Treasury Secretary Scott Bessent was the one who initiated that FX rate check that the Federal Reserve conducted in January. I mean, I guess it's not that much of a stretch, right, to believe that it was Scott Bessent, of course. But what would be the implications of this if it were indeed true?
Well, foreign exchange traders are getting very excited about this because there was speculation for a while that the Japanese authorities only heard about the FX rate checks after the event. They were not actually part of the process. There's been a report from the Nikkei today, hasn't been denied at all by the Japanese side so far, so people are taking it as being correct. So what it means is that as dollar yen starts to climb a bit higher, FX traders are now really looking to the Japanese side. They want to hear from Japanese authorities that they really want to draw a line in the sand for the yen weakness. That hasn't really happened yet. If that's the case, we could get a repeat of what we saw in January, where the dollar yen seemed to be allowed to just continue to climb higher after the Bank of Japan left interest rates unchanged. There seemed to be some kind of benign neglect from the Japanese side, and it was only when the US stepped in that we saw support for the Japanese currency. So here the onus has been shifted back to the Japanese Ministry of Finance. If we don't get some clarity from them, if we don't get some verbal support, or from the Bank of Japan on the other hand, it looks as though FX traders will take it into their own hands, and the path of least resistance will be for the yen to decline again. It's going to be a pretty exciting couple of days in the foreign exchange market as people test the boundaries of where both the US and the Japanese authorities see dollar yen going.
Well, we're at 155.12 this morning. Mark, thank you so much. That is Bloomberg M Live strategist Mark Cranfield. EU leaders, including European Commission President Ursula von der Leyen, are in Kyiv for a day of remembrance as Russia's war on Ukraine enters its 5th year. Despite President Donald Trump's pledge to end the conflict within 24 hours of taking office last January, there is no end in sight. Multiple rounds of talks have been taking place since then, including the Ukrainian president's very public Oval Office clash with the US president and Trump's summit with Russia's President Vladimir Putin in Alaska, where they spoke for around about 2.5 hours. Now, the sticking point obviously remains territory. 3 rounds of talks so far this year have failed to deliver a resolution. Putin has given no sign he's willing to roll back on demands that include territory his forces have failed to conquer in Ukraine's Donetsk region. Let's go to Bloomberg's Chief Europe correspondent, Oliver Crook. Ollie, divisions with the EU have been laid bare over a fresh round of sanctions against Russia. What is the next step here?
Yeah, absolutely. I mean, as we enter now the first day of the 5th year of this war in Ukraine that began before the dawn on February 24th of 2022, you have the European Commission President Ursula von der Leyen, the Council President Antonio Costa. They're in Kyiv today, and they were hoping to bring with them not just their presence in order to mark and remember this date for the Ukrainians, but also some financial support in the form of a 90 billion euro loan that had been agreed to at the European Council a couple of back in December, which now has been brought into question by Hungary, but also the sanctions package that was tried to be passed yesterday, and there were objections from both the Hungarians and Slovakia. So this obviously puts a damper on sort of the what the Europeans are hoping to bring to the table, already trying to struggle to find their voice in these negotiations between the United States, Ukraine, and the Russians. We heard from Antonio Costa, who was writing to Viktor Orban. So there was the sanctions as one issue, and now Viktor Orban is objecting to the loan to Ukraine, 90 billion euros, which is obviously, Vani, fundamental, because this will guarantee that the war can be funded and much of the Ukrainian budget to 2/3 of that for the next 2 years. That is now being called into question because of this lack of unity at the European level. So Antonio Costa wrote a letter to Viktor Orban in which he said, a decision taken by the European Council must be respected. When leaders reach a consensus, they are bound by their decision. Any breach of this commitment constitutes a violation of the principle of sincere cooperations. Now, we also know with interest that these two nations that are now objecting to this are the two nations that Marco Rubio decided to visit after Munich Security Conference. He was first in Munich, then he went to Slovakia, then he went to Hungary. Does that put these two leaders potentially in a more emboldened positions because they have this sort of tacit backing from the United States? But for the Europeans, again, this is going to be the big story for the next couple of months. How do they bring their own pressure to bear now that they have so much internal division, which is now effectively blocking their most significant contributions to Ukraine?
Yeah, absolutely. And Ollie, the outlook for broader peace talks spearheaded by the United States, I mean, as moderator, is the US getting anywhere here? Is it siding with one side more than another? Because it had been trying to bring both sides together, but surely there's difficulty there.
So what we've been seeing from the United States is, as you can see, from time to time, Trump sort of vacillates as to who he decides is the impediment to peace. It's very often, historically, very often been Zelensky in the mind of the president. It has sometimes been Vladimir Putin. And there are options on either side of that for the United States to bring sort of pressure to bear. It has seemed to be a sort of more finely balanced view right now that we're getting from the president of the United States. You know, of course, ending the war in 24 hours was the initial goal. It seems now the president has aimed basically July 4th this summer to try to get some sort of resolution over the line. That's obviously significant because it's the U.S. Independence Day, the 250th anniversary of the country, but also a win that the president of the United States would like to carry into the midterms, which seem pretty precarious for the United States. Not to say nothing of the fact that there could be potentially implications for the price of oil and inflation. All of that is very important for the United States. That being said, Vani, the last update that we have really heard, and has been from Marco Rubio in his tour of Europe, was that basically some days he feels pretty good about it, some days he doesn't feel that good about it, and that basically it's not clear whether or not there will be a deal. So we'll be watching it again very closely. The important thing, Vani, will be to see who the United States will put pressure on, whether it's Ukraine or the Russians.
And I'm sure we'll hear more about it at the State of the Union as well. Oliver, thank you so much. That's Bloomberg's Oliver Cook. And for more on this grinding war, Oliver will be speaking exclusively with the EU Foreign Affairs Chief Kaja Kallas next hour. That's at 7:30 a.m. London time. And still ahead, Standard Chartered announces a fresh $1.5 billion share buyback amid weaker than expected earnings. We're going to be speaking with CEO Bill Winters. That's at 6:30 London time. But first, AI jitters royal markets again. We'll discuss that and the US tariff impact with Frédérique Carrier from RBC Wealth Management just ahead. This is Bloomberg. The Black Swan is warning investors to brace for escalating volatility and potential bankruptcies in the software sector. Speaking exclusively with Bloomberg, Nassim Taleb said the AI-driven rally is entering a more fragile phase.
Historically, if you look at history, the car companies, airline companies, and of course the personal computer, okay, if you look historically, that those who started the business, the pioneers, are not necessarily the winners. As a matter of fact, they're probably more likely to be the losers. So now people take names of AI and say, okay, these are going to win, let's invest. I'm sure someone's going to make a lot of money in both software and hardware related to AI, but doesn't necessarily have to be these companies, because you have a lot of instability, both technologically and, of course, in geographically with AI.
The Black Swan author Nassim Taleb speaking exclusively there with Bloomberg. For more on this now, let's bring in RBC Wealth Management Head of Investment Strategy for UK and Asia, Frédérique Carrier, who joins us in studio. It's not exactly the boldest of calls, right? We've been hearing this for some time now. Look, there are going to be winners and losers. So for this to cause the market to take a tumble is a little bit of a head-scratcher, Frédérique. What is wrong with this market that it doesn't see that there are, of course, going to be winners and losers?
Well, the rotation we've seen has been very aggressive, and it suggests that the market is questioning in terms of the strategy that we tell our clients. We do think that there are some mega caps which are really oversold. Valuation are now compelling, and we look for these opportunities where there's been discriminate selling. And so we do think that there are some opportunities in terms of the AI disrupted shares, companies. We think that despite the very heavy derating, it's going to take quite a bit of time before there is a re-rating. A lot of these companies, their valuation depend on terminal value, and it's very difficult to assess what will be the impact in 5 years' time.
So what is an investor supposed to do if, say, an investor has a bunch of software stocks? What do you get rid of and what do you keep, and how do you assess that? How do you assess the economic mode, I guess?
I think we would wait till the dust settles, and we would take a very diversified approach to portfolio construction, not only in the US but also broadly through asset classes. And we would look for these stocks, as I mentioned, which are oversold, and we would bide our time. There's been this rotation out of these AI overall stocks into more physical assets, pharmaceutical, consumer staples, some industrials. Some of these stocks are now overbought. Valuations are expensive. We would expect some profit taking. And so we would wait till the dust settles, bide our time, and pick the stocks in a few weeks' time once we have a direction.
And I guess a lot of the market has been so concentrated that any kind of rotation like this really takes a toll. You say we're actually past peak tariff disruption. Please explain to us why that's the case, because it certainly doesn't seem like that to me.
So peak, if you think back of peak disruption, we think back of last April, the announcement of the Liberation Day. So we think that with the IEEPA tariffs being gone, the administration will have less power to dial up and down tensions with trade partners. These new tariff avenues don't have the same sort of power. So we think disruption will be less. It doesn't mean that there will be no disruption. There is disruption, we know, in the U.S. economy. Tariffs are having an effect on inflation, not as big as people thought, but still an effect on inflation, and certainly an effect on employment. Employment creation in manufacturing sectors which export is really struggling. Not enough to have a big impact on the labor market, but these sectors are affected.
So, Frédérique, would you actually make decisions today based on this, or would you wait just in case we see more investigations and different kinds of tariffs? I mean, you say, obviously, that the winners are going to be countries like China, Brazil, India, and the losers, the UK and Australia, the early deal makers, right? But are you confident investing that way just yet?
So we have to invest, right? We have to be invested. So we do remain invested. The one thing we're looking at is how the EU responds to this. This is the one to be confirmed trade deal. At the moment, they've decided not to ratify the trade deal. The two factors which made them sign this deal, so U.S. guarantees for Ukraine and the fear of retaliation, are still there. So eventually, we do think that they will sign, but the EU has been flexing its muscles recently, and so there is a risk of escalation, which wasn't there last year.
Frédérique, thank you so much. We have to leave it there, but always love chatting with you. That's Frédérique Carrier, Head of Investment Strategy for the UK and Asia at RBC Wealth Management. Plenty more to come. This is Bloomberg. Now to other top stories we're following this morning. European car sales fell in January, breaking a 6-month growth streak. New vehicle registrations declined 3.5% as consumer resilience and reticence in several markets overshadowed still robust demand for electrified models. France and the region's biggest market, Germany, led the drop, while sales rose in the UK and in Italy. UK police have arrested former British ambassador to the US, Peter Mandelson, on suspicion of misconduct in public office. The arrest comes after the US Department of Justice released emails allegedly showing Mandelson forwarding government information to Jeffrey Epstein. Police also searched 2 properties linked to Mandelson as part of their criminal probe. Mandelson's arrest deepens the crisis engulfing Prime Minister Keir Starmer over his decision to appoint Mandelson as US envoy, despite his known links to Epstein. Mandelson has not been charged, and his lawyer has declined to comment. JP Morgan CEO Jamie Dimon says he's starting to see parallels to the era before the 2008 global financial crisis, when a rush to make loans ended disastrously. Speaking to investors, Dimon responded to a question about fierce competition in the financial industry.
Unfortunately, we did see this in 05, and 06, and 07. Almost the same thing. The rising tide was lifting all boats. Everyone was making a lot of money. I don't know how long it's going to be great for everybody. I see a couple of people doing some dumb things. They're just doing dumb things to create NII or say they're, winning in the markets business, something like that.
And coming up, Standard Chartered announces a $1.5 billion buyback. We'll be joined by CEO Bill Winters for a full conversation next. This is Bloomberg. From London, this is Bloomberg Daybreak Europe. I'm Bonnie Quinn with your top stories. President Donald Trump's new 10% global tariffs kick in as the White House seeks to preserve the president's key economic policy. Stocks in Asia shrugging off the AI scare trade that dominated Wall Street as investors snap up chip makers. European futures pointed to a higher open. And the European Union fails to agree on a fresh round of sanctions on Russia as the war in Ukraine enters its 5th year. All right, let's take a look at these markets because, boy, did we see a little bit of a jolt yesterday. That Citrini report plus more comments from Nassim Taleb. As Ed Yardeni says today, we still believe AI is artificial but not intelligent. That's not what the market thought yesterday. The S&P was down 1%. The Nasdaq 100 was down 1.2%. It looks like we might be seeing a little bit of relief today, although that 10-year yield is down at 4.04 and change. And the 2-10 spread is now at 58 basis points. So we're really narrowing there. We also, of course, had Anthropic saying that its Claude code can help modernize COBOL. And that really caused a sell-off in IBM shares. A bit of a scare to IBM, which came out and said, look, we're not just a COBOL platform. We're also a mainframe platform defending itself to investors, I guess. And then the tariff uncertainty might be receding now that we know it's going to be 10%, at least for now, and not 15%. So all that's going on in these markets. Let's get a look now at your front page news. Beginning with the Wall Street Journal, the headline is Viral Doomsday Report Lays Bare Wall Street's Deep Anxiety About AI Future. As that hypothetical report by Citrini sparked concerns about AI disruption, causing pretty tumultuous stock moves. The Financial Times leading with former British ambassador to the US, Peter Mandeslon, being arrested by UK police on suspicion of misconduct in public office. And finally, French newspaper Le Figaro leads with the war in Ukraine entering its 5th year. The headline roughly translating to 4 years after the invasion, the Russo-Ukrainian conflict is at a standstill. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers do go to DayBgo. Standard Chartered has announced a fresh share buyback as it reported weaker than estimated fourth quarter earnings. We're joined now by Bill Winters, CEO of Standard Chartered. Bill, very pleased to have you in studio. Let's start off with that fresh $1.5 billion buyback. You must think the shares are pretty cheaply priced.
You know, our shares are a lot less cheaply priced than they were a year or 2 years ago, which is really good news. And I think we've got very strong momentum. But we believe in the company. We've actually produced a great set of earnings in 2025. Q4 was strong in almost every regard. I mean, really all of the key elements of our strategy are firing on all cylinders. And while the share price has appreciated a lot, we think there's a lot further to go. So we're very happy to buy an additional $1.5 billion back. We also significantly increased our dividend in the fourth quarter, so for the full year of 2025. And that's a further sign of confidence in our ability to grow our earnings from here.
Now, the shares have been a little bit all over the place. You were at all-time highs earlier this year, but then, of course, earlier this month, your CFO left. And I'm curious, is that a sign that investors really want a succession plan in place? And sorry to ask you this, but, do you have one?
Of course we have one. We always have one. First of all, I don't think our shares have particularly reacted to the departure of any one person. It's a team. And you'll see, in fact, today when we announce our earnings, I'll be sitting with our interim CFO and our head of investor relations, who had been working for the CFO, who are absolutely outstanding. And so we're not missing a beat in that. But of course, the market now wants to know, you had several internal successors. One of them possibly seems to, he definitely left, possibly a successor, is gone. What's next? The good news is we've got a great bench inside our bank. I mean, it's the best management team that I've worked with in my 11 years at Standard Chartered. And I think it's a highly desirable job for people outside the bank as well. So should the board, of course it's a board decision, not mine, my job is to develop the internal candidates. I think they're in great shape, and I'm not worried at all about our future.
You've been there 11 years. How long do you want to run the bank for?
We've got a strategy day or a capital markets day coming up in May. I'm definitely going to deliver that, and I want to deliver the strategy, right? I want to see that strategy through. Now, how long that takes, we'll see. I work at the behest of the board, but for the time being, I think investors should be confident that, one, we've got great momentum in our business. We've got a really, really strong 2025 behind us. We've indicated we've had a strong start to 2026. Early days, but nevertheless, nice to be able to say. We're going to have, I think, a quite compelling investor day in May. And we're going to see it through from here.
Okay, you have my interest peaked now because you keep saying it's going to be compelling, and of course all investor days were compelling, but you also said that you want to deliver the strategy. It's about to expire, and does that mean we might hear something in May about your future?
Oh, I don't know what's going to expire. We set out a bunch of financial targets 2 years ago that took us through 2026. We've actually hit all those financial targets in 2025, or so a year ahead of schedule on every single front. So this is a good time for us to refresh that guidance, which we'll do in May. We gave some guidance for 2026, which is quite encouraging. We upgraded our guidance for the remainder of this year, based in part on the strong start, but substantially on the really good momentum that we had through 2025. But in the Capital Markets Day in May, we'll give some longer term guidance. But more importantly, we'll talk about the strategic themes that are really sweeping the economy, but also finance. We know about the fragmentation of financial markets. We know about AI. We know about we have some ideas about the digitization of money. These are big things that are sweeping finance, and we're extremely well positioned on all of them.
So what will you be telling investors? And give us a little sneak preview.
Well, I can't give you a sneak preview.
Well, just a little bit. Will you be talking about maybe you want an M&A strategy from here on out? You haven't really done much M&A in your tenure, at least.
No, we haven't needed to. And all of our growth has been organic. And when we're growing our wealth business, which is an absolute jewel, fastest growing wealth manager in Asia, third largest overall, closing the gap to 1 and 2. We've done that entirely organically. And, this year has been a 20% plus growth year. I don't know that we can always do 20% plus.
So are you looking for targets?
If there was something that was additive to our organic strategy, that was accretive, of course we'd look at it. But when you're growing the way we're growing, you definitely don't need to distract yourself with an acquisition, unless it's very compelling. So we're just full speed ahead. We're investing substantially. Yeah, I mean, we're returning a lot to our shareholders, but we're investing very substantially in the business, and we'll continue to.
Have you been looking at any books or doing any due diligence on any companies?
No.
Okay, well, that's fair enough. Talk to us a little bit about your idea that, Hong Kong and Singapore, you wouldn't want to have to choose between them. But if you really, really did, if you had to choose one, would there be one that would tip?
Yeah, thankfully we don't. So it's really is hypothetical. And of course, it's London works for us. I mean, London has been our headquarters from inception. It works for us in a number of regards. One, it's quite a sophisticated regulatory regime. I think the fact that now successive governments, Tory and Labour, have both endorsed this competitiveness as a secondary objective for the regulators means that the regulators are becoming less assertive in terms of, I would say, eliminating some of the disadvantages that we've had historically in the UK, but also Europe. So you've got a sophisticated regulatory environment. You've got we're a global bank. London has always been a good time zone, super infrastructure, et cetera. So thankfully, we don't need to choose, and I don't expect we will anytime soon.
What about China these days? It feels like there was a time maybe a couple of years ago when everyone was saying it was uninvestable, and then it went through, quite difficult periods. It seems to be on the up again now, and even, the global regulatory environment and the global sort of trade environment is maybe even more favourable. What are your thoughts on China?
We're super bullish on China, and that's not to say that we think the market's going up tomorrow or that commercial property prices are going to increase. I mean, China has its challenges, for sure. But the technology investments that China has made in leading edge technologies, the super high savings rate in the country, which is actually a drag on GDP growth, but it holds a lot. It tells a lot about their future in terms of the ability to deploy that capital into productive resources. These are very encouraging things. We've seen that the trade flows on the back of the tariff back and forth, and it's obviously not just been tariffs. There's also been protectionism going in all directions, industry arguments, etc. Trade is still very strong. Global trade is up. The Chinese trade surplus is up overall. Although it's down with the U.S., it's up with the rest of the world to a greater extent. So, China is going to be fine. The U.S., I think, will also be fine. Both have economic challenges to address. I hope that the summit that the two leaders have in April will be one that sets an entente for how they can cooperate, or at least not destructively compete.
Yeah, well, so a bifurcated question then, does somebody win out in the AI war, or, just the globe win in general? And then also on the trade war, does one win out?
I don't think anybody wins in a trade war. We know that trade increases productivity and overall prosperity. We also know that trade can leave people losing, leave people behind. So I hope that as we reset the global trading agenda, we're more aware than we were during the industrial hollowing out in the U.S. and Europe about the people that will otherwise be left behind. And of course, that will be very relevant in the case of the advent of AI. I think in AI, there will be winners and losers as well. And I think what we're clearly seeing right now is that the winners are companies that are transforming themselves faster than their competitors using these very powerful tools. The people that build the tools, we'll see. It's very hard to tell whether the massive investments in AI will be good for the people that are.
Sell-offs, though, are scary, right? I mean,
well, but the run-up was scary as well. So, I mean, we're selling off from a very high level.
I do want to ask you, because you said income growth will be around the bottom end of the 5 to 7% range. You had previously guided at the top end. You also said net interest income is going to be flat this year. You know, you could quibble that this is not a huge range and therefore it's not a big difference. But what is causing that little tiny bit of weakness?
No, well, it's not weakness. It's strength. Because we've had such strong growth in 2025, we're calibrating what we can then carry on to do in 2026. We call it the base effect. So you know, we've had super growth in 2025 across all of our lines of business, and we expect that to continue. The fact that we think we can produce flat-ish net interest income next year despite interest rate headwinds, and we'll have a tailing off in the Hong Kong interest rate, which is HIBOR, which is very relevant for us. The fact that we think we can go flat there is already quite a good outcome, and I think the market's happy about that. But to get to that 5% plus income growth, that means that our non-net interest income is going to be growing in double digits, which the market is quite impressed by, and I think they're reacting favorably to that.
Well, Bill, congratulations. I know the bonus pool has grown by 10% as well, so you're keeping your employees happy very much as well. That is Standard Chartered CEO Bill Winters. The ECB President Christine Lagarde has warned of the importance of central bank independence in dealing with inflation expectations. She was speaking after being awarded the Paul Volcker Prize at the National Association of Business Economics in Washington.
Without that independence being protected, being cherished, and being celebrated, as well as protected by accountability, I don't think that we would be capable of responding in the way we have, I think, to tame inflation, to control and respond to inflation expectations in the way we have. I think it's in the DNA of efficient central banking. And, it's not a recipe for perfect success, and it's not to be seen in isolation. I think that it doesn't go without accountability. And if I look at my own central bank, the ECB, on Thursday, I'll be in front of the European Parliament to answer any question that the members of the European Parliament have on our monetary policy, on key themes that they select to discuss. And I think it's a critical component of that independence. So it's not unchecked independence. It's independence with the strong consideration of accountability to the representatives of the people.
Yeah, so independence does not mean isolation. I think you said that to Parliament as well. I'd like to ask you about a few weeks ago.
By the way, sometimes people think, oh, okay, well, the central banks are in this ivory tower and they have no understanding and no clue about what's happening in their economies. Mm-hmm. I think that is vastly unfair and not true. If I look at the institution I know best, the ECB, number one, we have constant contact with the corporate world, whether it's financial or non-financial corporates. Number two, we go out a lot and do a lot of reaching out. And I really command my executive board members to, go to basis, go to the grocery store and understand, the fabrics of life. Because it's always tempting to, retreat to academic work and to reading forever. No, it has to be grounded and rooted in real life. And I think that's part of the accountability as well.
ECB President Christine Lagarde. Coming up, new measures on healthcare and drug pricing. What can we expect from President Trump's State of the Union address? This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some corporate news. Bloomberg understands that Anthropic is offering some current and former employees the ability to sell shares in the company at a valuation of about $350 billion. Sources say that would allow them to cash in at the same level as the recent $30 billion funding round. Bloomberg has been told that Paramount Skydance has raised its offer to buy Warner Brothers Discovery. Sources say the new bid improves on Paramount's $30 a share proposal made in December and addresses some concerns around financing. If the Warner Brothers board decides the new offer is superior to its current deal with Netflix, the streaming giant will have 4 days to respond. Trials of Novo Nordisk's next-generation obesity shot have disappointed after it delivered less weight loss than a rival drug by Eli Lilly. Novo's shares fell as much as 16% on the news, while Lilly's shares gained. U.S. President Donald Trump will speak to Congress later today in the first State of the Union address of his second term. The speech will showcase the Republican president and his party's agenda ahead of crucial midterm elections later this year. To discuss further, I'm joined by Bloomberg Politics editor Laura Davison. Laura, first, do you think the speech was frantically rewritten in the last 24 hours?
It's very possible. Trump always goes into a lot of these speeches with talking points. There are sort of key measures that are inserted into the teleprompter, but then he does a lot of riffing, what he calls the weave, in between some of these key points. So it's likely that he will have some prepared remarks, but also do a lot of speaking off the cuff. His advisors really want him to stick to speaking about the economy, his record of tax cuts, as well as some of these plans that he's touted to going into the midterms to lower the cost of living, things like housing affordability, the decrease in energy, some of the AI investments, as well as having technology companies pick up the tab for some of their energy bills as it relates to AI. But it's also possible he could speak on a whole wide range of things. One close thing to watch for in particular is tariffs. What does he address in terms of what his next steps are there? He also, has recently attacked some of the Supreme Court justices who struck down this his sweeping tariffs just last week. Many of those justices will be in the room right in front of him in the front row in the Capitol tomorrow, and so this will be a big question about whether he will sort of directly address them, and particularly if he will insult them to their faces.
Right, it's going to be so fresh in his mind, right? But he does have other concerns, as you say. He has to think a little bit maybe longer term. And I'm curious, will all of his pledges hinge on corporate America, or will he also be reaching out to Congress in a way and asking for Congress's help?
Yeah, this is a huge, audience that he has. He, of course, has the public watching. He has the members of Congress in the room, as well as, kind of corporate leaders looking for signs here on what happens. Trump's tariff that went into effect at midnight, just a couple hours ago in the U.S., that 10% levy is only in effect for 150 days. He needs Congress to renew that. So if he wants to move forward, he needs to build support in Congress. It is, at least right now, looking highly unlikely that will happen. You have, Democrats united in opposition to his tariff agenda, and as well as some Republicans who have recently voted against at least portions of the tariff agenda. So this, is going to be a hard sell going in. Republicans, who are facing an uphill battle headed into these midterms, want him to stick to talking about things like tax cuts, things like, future plans to lower the cost of living. They are not at all excited for him to talk about, things like, perhaps higher tariffs in the future, or, going off script on new controversies that could create problems for them back in their districts at home.
Yeah, and you mentioned it. It's a massively wide gap at the moment between his approvals and disapprovals, right? A 16-point gap, a 57% disapproval rating on average. What can he do to narrow that, Laura, given that even his fervent supporters have been thrown off recently by things like Epstein, the tariffs, and so on?
Yeah, this is, sort of a huge question that his advisors are grappling with right now, particularly on what were his signature issues, the economy and immigration. He is now underwater on his approval there. So his advisors are asking him to pull back on some of the most aggressive stances on immigration that he's taken. He's done that in Minneapolis, pulling out officers. On cost of living, this is sort of be the most important issue. The question is, is there anything that he can do to get consumers feeling better about the economy? There's been tons of uncertainty. While job data has been, relatively strong, there's been some concerns there. Prices, particularly in some sectors, looking at beef and energy in particular, continue to rise. This is all really vexed voters, and they're just not feeling good, as they're headed into 2026 and elections later this year.
All right, Laura, we will be eagerly watching, even if we have to stay up all night. Bloomberg politics editor and Washington deputy bureau chief, Laura Davison. Plenty more coming up. This is Bloomberg.
But if the good labor market news of January is revised away or evaporates in February, it would support my position at the FOMC's last meeting that a 25 basis point reduction in the policy rate was appropriate, and that such a cut should be made at the March meeting.
Fed Governor Chris Waller speaking at an event in Washington with the National Association for Business Economics. All right, let's have a look at some charts that might illuminate your day for you. This was the picture for IBM yesterday, a really poor picture. In fact, it caused IBM to actually come out with a blog post saying, we are not obsolete. We are not just a COBOL language or a platform for COBOL. We are actually a mainframe platform as well. And this, of course, after Anthropic came out and said, it's Claude Code can maybe do COBOL better than COBOL itself. So that'll show you this is as big a drop as we've seen since the year 2000. Don't want to suggest that there's any echoes there, but a lot of people are suggesting it. Let's move on to the next chart because we are also seeing this rush into safe havens. So this mainly on the tariff uncertainty, but you can throw in AI in there as well. That's been having a huge impact. Gold has continued its incline. So remember, we had a bit of a drop off. Well, we are well off our 50-day moving average now. We're not even that far off the record that was set January 29th at 51.70 there on the price of gold. And then maybe to illustrate it even further, let's take a look at Bitcoin because the diamond hands are folding, it seems. We just keep continuing to drop for Bitcoin. 60,000 is the next level to watch. Open interest is also fading. But of course, a couple of years ago when we were at 70,000, it was, a huge price. So we'll just see how all of this shakes out. To access all of these charts, do have a look at the Chart Go function on your terminal and save them. Now we have the Chicago Fed President Austin Goolsbee. He's coming up on open interest at 2:30 p.m. London time. The opening trade is next. This is Bloomberg.